In 2014, Forbes estimated the Los Angeles Clippers were worth $575 million. 3 months later, Steve Ballmer bought them for $2 billion. Not $600 million. Not $800 million. $2 billion. Forbes wasn't off by 20%. They were off by 248%. That wasn't a one-time mistake. In 2022, Forbes valued the Phoenix Suns at $2.3 billion. Matt Ishbia paid $4 billion. A $1.7 billion gap. In 2023, the Charlotte Hornets sold for $3 billion. Forbes had them at $1.7 billion. Wrong by 76%. This is not a pattern of bad estimates. This is a feature. A system designed to produce numbers that look authoritative, and are almost always wrong. And the people who publish those numbers have almost no incentive to fix them. Because the people who own the teams benefit from the lie. By the end of the next 15 minutes, you'll understand exactly how NBA valuations actually work, why the published numbers are scientifically nonsense, and who profits from keeping you in the dark. Let me say that up front. The entire valuation industry around the NBA is wrong on purpose. So how does Forbes, or CNBC, or Sportico, actually arrive at a team's value? It starts with revenue. Forbes takes a team's reported revenue, ticket sales, sponsorships, media rights money, and multiplies it by a number. That number, called a revenue multiple, is supposed to represent what a buyer would pay for each dollar of revenue the team generates. In 2013, Forbes used a multiple of about 4.2 times revenue. By 2019, it was 7.3 times. In 2025, Forbes pegs the average NBA multiple at 12.9 times revenue. A threefold increase in 12 years. Here's the problem. The multiple Forbes uses is backward-looking. It's based on what teams sold for in the past, not what a buyer would pay today. It's like pricing a house based on what houses sold for 3 years ago in a neighborhood where prices double every 18 months. And there's an even bigger problem. They guess at the revenue. NBA teams are private businesses. They don't release audited financials. Forbes calls sources, team executives, bankers, league officials, and assembles estimates. Some teams cooperate. Some don't. Some actively mislead. The league has every incentive to keep revenue numbers conservative. Which means the starting number is a guess, multiplied by a backward-looking multiple. That's the formula. But the real question is, what does the market actually think these teams are worth? We'll get there. But first, you need to understand what happened to the multiples. Because the multiple itself tells a story nobody's paying attention to. In 2013, $1 of NBA team revenue was worth $4.20. Today, that same dollar is worth $12.90. What changed? Did basketball get 3 times more profitable? Did the product become 3 times better? No. The asset just got 3 times more scarce. And that's where the real story begins. In 2014, there were 30 NBA teams. In 2025 there are 30 NBA teams. 0 new supply. In a decade of exploding global demand. The NBA now generates an estimated $12.25 billion annually across all 30 teams, roughly $408 million per club. The new $76 billion media deal, signed in 2024, bumps each team's national TV payout from $103 million to $143 million per season. And the league's international business, especially in China, generates roughly $500 million annually, and is growing. So demand is surging. National media money is surging. International revenue is surging. And supply hasn't moved. Not one new franchise. The 30 seats at the table are the same 30 seats that existed in 2004, when the Charlotte Bobcats joined the league for $300 million. When demand explodes and supply is frozen, you don't need a spreadsheet to predict what happens to price. It goes up. And it doesn't go up gently, it goes up violently. Think about what this means for a valuation. Forbes can raise its multiple from 7x to 13x. That's a big adjustment on paper. But if a real buyer in a real auction is willing to pay 18x, or 20x, and there's only one asset and multiple bidders, then Forbes isn't measuring value. It's measuring last year's weather. And here's where it gets uncomfortable. Because the valuations aren't just inaccurate. They're inaccurate in one direction. Always too low. Never too high. There has never been a major NBA franchise sold below its Forbes valuation. Not once. Not a single recorded instance. Every meaningful transaction, Clippers, Nets, Rockets, Suns, Hornets, Mavericks minority stake, Timberwolves, the sale price exceeded the published estimate. Often by billions. That's not an error bar. That's a systematic bias. Why? Why do the numbers always miss in the same direction? The answer is hiding in plain sight, in the most important NBA transaction that hasn't happened yet. In March 2026, the NBA's 30 owners voted to explore adding 2 new teams, Seattle and Las Vegas. The projected expansion fee per team? $7 to $10 billion. Let me say that again. To join the club, you write a check for up to $10 billion. And that money goes directly, every cent, to the existing 30 owners. At $8 billion per team, times 2 teams, that's $16 billion. Divided 30 ways. $533 million per owner. In cash. Taxed as capital gains. The expansion fee is the single most honest number in the entire NBA valuation ecosystem. Because it's not theoretical. It's not a Forbes estimate. It's a price that will be paid by a real buyer, in a competitive bidding process, with real money. And that number, $7 to $10 billion, tells you everything the published valuations won't. If a bare expansion franchise with no arena, no roster, no brand, no history, just the right to exist in the league, is worth $8 billion, then what is an actual existing franchise worth? A team with a stadium, a fanbase, a century of history, star players under contract? Forbes says the average NBA team is worth $5.4 billion. The expansion fee says the floor, the absolute floor, is nearly double that. You cannot have an expansion team worth $8 billion and an existing, revenue-generating franchise worth $5.4 billion. The math doesn't compute. One of those numbers is fiction. The expansion fee is the market telling you, in real dollars, in real time, that every single published team valuation is low by billions. And nobody involved wants you to notice. But there's a deeper problem. And it's embedded in the single most important number in this entire equation. The revenue multiple. 12.9 times. That multiple assumes future revenue will grow, consistently, predictably, forever. It assumes the $76 billion media deal will be replaced by an even bigger deal in 2035. It assumes China keeps growing. It assumes streaming economics don't fragment the way they fragmented cable. It assumes international markets never cool. But what if one of those assumptions breaks? The current media deals pay roughly $6.9 billion per year. That's more than double the previous $2.6 billion annual deal. The leap was historic. But media companies aren't buying NBA rights out of charity. They're buying them because live sports are the last thing keeping the cable bundle alive. If the bundle dies, and it's dying, and streaming economics prove less generous than cable economics, and they are, then the next rights deal in 2035 might not clear $76 billion. It might not clear $50 billion. And if the national media money shrinks, every team's guaranteed revenue shrinks. And if revenue shrinks, the multiple shrinks. And if the multiple shrinks from 12.9x to 8x or 7x on a lower base of revenue, you're not looking at a $5.4 billion average team. You're looking at a $2.5 billion average team. That's not a correction. That's a collapse. But here's what makes this whole system truly diabolical. The people who own these teams already know this. They've built a backdoor exit. And it's the most underreported story in professional sports. In 2022, the NBA changed its ownership rules. For decades, teams had to be controlled by individuals. No institutional investors. No private equity. No sovereign wealth. But in 2022, the league allowed private equity funds to buy up to 20% of any team. And then, in 2023, They raised it to 30%. And the funds moved fast. Dio Capital bought stakes in the Suns, the Kings, the Hawks. Arctos Partners bought pieces of the Warriors and the Jazz. 6th Street grabbed 20% of the Spurs. Here's why this matters for the valuation lie. When a PE fund buys 20% of a team, the transaction establishes a real market price. Not a Forbes estimate. A real price, with real money changing hands. And those implied valuations consistently exceed the published numbers. Dial's Suns stake, for example, implied a valuation above $5 billion, while Forbes was still publishing $4 billion. But that's not the most important part. The PE funds are buying minority stakes. No control, no voting power, no operational authority. They're writing 9-figure checks for the privilege of sitting in the owner's box and waiting. Waiting for what? Waiting for the team to appreciate? Sure. That's the story. But there's a second story nobody talks about. The PE funds are buying liquidity for the owners. An owner who bought in for $200 million 20 years ago is sitting on a team worth, by real market standards, $5 to $8 billion. But they can't sell the whole thing without triggering a tax catastrophe and losing the asset completely. Selling 20% to a PE fund? That's $1 billion in cash. Taxed at capital gains. And they keep control. The valuation lie makes this possible. If Forbes says the team is worth $4 billion, the PE fund paying a $5 billion implied valuation looks like it's overpaying. The transaction flies under the radar. Nobody asks hard questions. The owners cash out, quietly, while the published numbers keep the story clean. Let me connect the dots. Because by now, you should be asking one question: if the valuations are systematically wrong, and they're always wrong in the same direction, downward, who benefits? The owners. Low published valuations keep tax assessments down. They keep estate planning costs down. They suppress expectations in labor negotiations. We're barely making money, when in reality the asset doubled in value. And they make the appreciation story look smooth and institutional, rather than what it actually is, explosive and speculative. The league. The NBA wants to project steady, predictable growth. 10%, 12%, 15% per year. That's the story they tell sponsors, media partners, and city governments. A valuation that jumps 40% when someone actually writes a check would terrify the ecosystem. Smooth numbers keep everyone calm. The media. Forbes, CNBC, Sportico. These outlets sell the illusion of precision. They publish rankings. They generate headlines. They create a product. Admitting their methodology is structurally flawed would undermine the entire value proposition. So they refine the multiple, tweak the revenue estimate, and publish the number as if it were audited. And the fans? We're told our team is worth $5.4 billion. We see the owner crying poor about the luxury tax. We see ticket prices going up. We don't connect the dots because the numbers don't make sense. And they're not supposed to. There's one more piece. The darkest piece. And it has to do with what happens when the music stops. The Celtics are about to sell. Current projections suggest a price tag between $7 and $9 billion. The Timberwolves ownership dispute has revealed internal valuations far above published estimates. The expansion fees are landing between $7 and $10 billion per team. Every Real transaction says the same thing. The published valuations are meaningless. But here's the danger you need to understand. The entire system, the revenue multiples, the media rights assumptions, the expansion projections, the PE minority stakes, it all works as long as the line goes up. As long as the next deal is bigger than the last deal. As long as global basketball demand keeps rising. As long as China keeps watching. As long as streaming platforms keep bidding. What happens if one of those assumptions breaks? In 2014, the Los Angeles Clippers sold for 3.5 times what Forbes said they were worth. If the same gap exists across the league today, and the average Forbes valuation is $5.4 billion, the real market price is closer to $15 to $19 billion per team. Not $5.4 billion. But if the assumptions that support those prices break, if the next media deal shrinks, if international growth stalls, if interest rates stay high, then the gap between the published number and the real number doesn't close because the real number climbs. It closes because the real number collapses toward the published number. And the published number was always a fiction to begin with. That's the massive lie. The valuations aren't just wrong. They're a house of cards built on assumptions nobody wants to test. Here's what I want you to remember. The next time you see a headline that says the Golden State Warriors are worth $11 billion, or the Knicks are worth $6.6 billion, or the average NBA team is worth $5.4 billion, understand what you're actually looking at. It's not a valuation. It's a marketing document. A real valuation requires a real buyer, writing a real check, in a real transaction. Everything else is storytelling. And the NBA, the owners, the league, the media ecosystem built around it, they're all telling the same story. The smooth, predictable, safely under market story. But the truth is written in the sale prices. It's written in the expansion fees. It's written in the PE minority stakes. And that truth is uncomfortable. It says these assets are worth 2 to 3 times what they're reported to be, and that the entire system depends on nobody looking too closely at the gap. The numbers are wrong. On purpose. And now you know why. If you want the version of these stories the mainstream gets wrong, the real mechanics, the hidden forces, the second story, hit subscribe. We just dropped our breakdown of the brutal economics of an NFL team. Go watch it. That video will change how you watch a Sunday kickoff forever. And our deep dive into SpaceX $1.7 trillion valuation, except when it doesn't, is right there on screen. The numbers are wrong. And we're just getting started.